think Warren Buffett says the first rule of investing, don't lose money. And then the second rule of investing is don't forget the first rule. Commodities are necessary for the functioning of a modern economy, whether you're a coffee farmer, oil and gas producers. We think there's significant demand and significant undersupply. You have to have EM navigational skills.
Which we have because we're Gemcorp.
Because we're Gemcorp. You have to have credit skills. Ultimately, we are credit investors. And you have to have the infrastructure that supports those skills.
Trade wars, tariffs, our new favorite word. This is going to be impacted by that, is it not?
We actually see a lot of opportunity in the trade disruption.
Hello and welcome to Gemcast, the podcast from Gemcorp Capital, where we explore the key themes across emerging and private markets. Today I'm joined by Ahmad Al-Sati.
Very nice to meet you. Thank you for having me.
Welcome, Ahmad. And we're talking about commodity-backed credit, where it comes from, what it is, its crossover with private markets and trade finance, and the kind of outcomes it can offer investors. So look, most people who are listening here are not going to be particularly familiar with this idea of kind of commodity credit and kind of how it converges with the private space. Do you want to just give us a little insight into kind of what it is and kind of where it's come from, how it's come into being?
Yeah, so I think Warren Buffett says the first rule of investing, don't lose money. And then the second rule of investing is don't forget the first rule. And we think credit allows you to protect against the downside. Because again, these are highly negotiated transactions. They're bespoke in nature. And we are ultimately high-touch investors. Yeah. And credit allows us to invest in these asset-rich, companies, producers, traders that require capital to manage their businesses. Yeah. And we can provide them with flexible solutions that meet their needs and requirements on a going forward basis. No two trades are the same, but ultimately our framework is the same, which is high attachment points, high senior secured, hard currency. And so we think that credit provides us and our clients with the optimum solution because it dampens volatility, it generates an income, and allows us to kind of protect against the downside on a going forward basis.
Okay, that makes sense. And is there a big demand for this kind of financing? Like how big is the demand that we have to meet?
Yeah, so these are very, very large markets. If you look at trade finance, which is one of the areas that we use to participate in commodities credit, that's a $9.7 trillion market. And the Asia Development Bank estimates that the commodity gap, i.e. the demand between funding and supply and demand of capital is about $2.5 trillion.
Okay.
The commodities credit to metals and mining, for example, which is just a subsector of the larger commodities complex, is being estimated to be $2.8 trillion by 2028. So these are very large pools that we're swimming in. Okay. And that allows us to kind of pick the best-in-class counterparties and the best-in-class deals across a variety of commodities.
Okay, so massive need for funding, so kind of huge demand for capital, which is always good if you've got that capital to allocate. And so, okay, from an investor's perspective, credit in commodities, I must admit, that's not something that I've heard loads of times. So how does that differ from the kind of traditional way of investing in commodities?
So when people think commodities, when I say people, I'm a commodities investor, people immediately think it's either public equities or futures, right? And we think that public equities and futures have a role to play in a portfolio, but they might be a suboptimal way to invest in the commodity space, right? Public equities tend to be volatile. You have limited control over what's going on. You're really subject to the performance of the underlying commodity, and there could be a beta play on commodity prices. Yeah. With futures, we think have some issues within their structure. They're necessary for hedging. They're necessary for producers to manage their risk. But from a financial investment standpoint, you actually have to predict the direction of the commodity. Is soy going up? Is soy going down? Is oil going up? Is oil going down? We think that these, there are people who are very good at predicting that in very short periods of time, but over a longer horizon, they're subject to such a variety of factors and variables that it's a very difficult proposition. They also don't generate income. They suffer from tracking errors. And in contango markets, they have negative roll yields, which means that as the price of the commodity is increasing, the price of the future is more expensive. And if interest rates are low and you're not getting paid enough on your cash collateral, you can actually have a negative return investing, even though commodity prices are going up. So we wanted to use credit to take a view on commodities because that allows us to participate in generate income for our clients, dampen the volatility, and allow us to participate in any margin increases if they occur.
Right. So you're kind of exploiting this sort of structural trend for commodities, which you've highlighted a little bit, and you're doing it through a way of essentially dampening volatility and more kind of doing that commodities play in a much more structured, conservative way that generates an income. Okay, makes sense. But what commodities are we talking about here? So you talked a little bit about metals and mining, but like, does commodity credit cover the full spectrum of commodities from hydrocarbons to agriculture and more in between? Can you shed some light on that?
Yeah, because we believe that commodities are a diversifier in a portfolio, right? If you look at commodities generally, the literature says, whatever that's worth, that you should have between 6 and 9% of your portfolio in commodities because they are an inflation hedge. Every time there's inflation goes up, commodity prices go up. They're a geopolitical hedge. Every time there's a geopolitical event, commodity prices go up. Actually, if there's a weather event, commodity prices tend to go up. And when inflation tends to be higher, around 3%, they're negatively correlated to bonds, and they're not as much correlated to the U.S. large cap equities. And so what we want to do is be able to provide that diversification across commodities. So agriculture, precious metals, industrial metals, so think battery metals, and energy, both hydrocarbons and renewables. Because each commodity in itself has its own supply-demand dynamics. Okay. So some commodities can be going up when others are going down. They each have their own weather patterns, especially in agricultural products. So if I have a frost in Brazil and a certain coffee has become more expensive, I might not have that frost in Vietnam, which is also a coffee producer. Yep. So we're able to hedge across that. And then some commodities are better diversifier in certain conditions than others. So think of precious metals or gold. They tend to be a very good diversifier in bear markets, where this risk is heightened and gold goes up, versus oil, for example, does well in boom markets when things are going well. And agricultural products and metals tend to be a significant diversifier across market conditions. So we want to be able to provide capital solutions to our clients across those verticals and across the commodity complex. And in each one of these commodity sub-verticals, there's significant demand for capital, whether you're a coffee farmer, oil and gas producers, metal and miner. We think there's significant demand and significant undersupply of capital.
Okay, right, that makes sense. So just to help me understand, can you sort of describe a typical commodity credit kind of deal in the private space that you're doing? Like, what do they look like? How are they structured? So that you can kind of bring it to life.
So we want to be able to provide a capital solution to our counterparty that meets their capital needs and requirements. But within that, we have a framework that we'd like to work in, which is we need to be senior secured in the capital structure. We need to be paid in hard currency. We need to have one point of enforcement. Yep. Okay, so that we can, if things go sideways or wrong, we can get the collateral. And we need to be structure these transactions offshore, where we don't take local jurisdictional risk. Okay, and we do that across a variety of verticals. We can have short duration credits, so transactions that are 2 weeks, 6 weeks, 30 days, 90 days. Okay. That's your typical, what people call trade finance or supply chain financing. We can have direct lending under circumstances for producers that have significant amount of assets and collateral. Yeah. So unlike a software company or a healthcare company or any other company that has intangibles, if things go wrong, the value of the collateral can diminish to zero. Yeah. Right? In a farm, in a mine, in an oil and gas, there might be some disruptions in price where you can lend at the right time in the cycle and benefit from the upside. But the asset is in the ground. The asset is there. There is liquidation value. There is downside protection and a floor to that value if you structure it correctly. In trade finance, a ship of oil or ship of soy, these are highly liquid markets. And so if we're lending at a significant discount to LTV, dependent on the volatility of the underlying commodity, and we have to sell that product or sell the bill of lading for third parties, we're able to sell it in these highly liquid markets, get back our principal or interest or fees, etc. And so we like to structure transactions that meet the needs of our counterparty,
Yep.
because then they come back for more.
Fine.
And we establish a long-term relationship with our counterparty because they see us as a trusted partner in the capital provide, and they come back for more. And in times of dislocation, so for example, we were lending to an agricultural producer.
Yep.
There was a dislocation in that market.
Okay.
And because they needed capital in short notice to aggregate a lot of the product they needed, we started lending them to 600 basis points more than we were lending on an annualized basis.
Because their margins.
Because their margins increase, and they look at us as a margin play rather than yield play. We are a partner with them in managing their business. And so if their margin increases, they're willing to do that. And at one point, we were lending to them, 2,000 basis points above. And they were happy to do that.
Yeah.
Those were for few short cycles.
Yeah.
So that usually doesn't happen. But we got the increase in 500-600 basis points above that.
Yeah.
Which was helpful to us.
Okay, that makes sense. So forgive me, Ahmad, this sounds a little bit too good to be true. I'm senior secured, I'm hard currency, I'm asset backed. The duration means I can be flexible about my pricing. It's an inflation hedge. I mean, there's some risks here, right? So you got to tell me what the risks are.
There is always risk. This is the business we're in, is understanding risk and mitigating against risk. And I would say that in this business, the risk is twofold.
Yeah.
The biggest risk, and everybody knows that, especially in the trade finance part of the business, is fraud.
Okay.
Am I financing a bag of rocks or am I financing a bag of nickel?
Okay.
And here at Gemcorp, our founders have invested in building what is effectively a commodities servicing business.
Yeah.
Okay? And we have almost 100 people that focus on sourcing, diligencing, monitoring, and monetizing trade finance globally.
Yeah.
And so they're able to help us vet the counterparty, understand, check out on the product. If we don't have people on the ground in Europe, in Africa, in the Middle East, increasingly elsewhere, they know who to contact in any very specific port. They can be a trusted partner for them to vet those transactions. They understand how the documentations work, and we're able to structure transactions that really protect us against the downside. And so having an infrastructure that supports our fund, so you have an asset management business supported by a commodities servicing business, having that significant infrastructure puts us in a very unique position given our size, right? The very largest commodity traders have that infrastructure, but they're largely financing their own flow.
Yeah.
And I, as an investor, can't get access to that flow or those cash flows.
Yeah.
Most of those guys are private companies.
Yeah.
And so we want to be able to structure so that investors can get access to those cash flows and have the benefits of that infrastructure that we spent 8 to 10 years building, perfecting, and expanding. So that's risk number one, fraud. Okay. Risk number two is credit. Ultimately, this is a credit product. And what that means is we are fundamentally a credit analysts and credit investors.
Yeah.
And we have to understand what the credit is, what the collateral package looks like, what is the enforcement on that collateral, how things can go wrong, and how we can foreclose on and sell the underlying collateral. You should not be a lender if you're not willing to foreclose. And so you should be able to structure transactions where you understand if you're not getting paid, you can work with your counterparty, or unfortunately, you're going to have to take the collateral to get back your investors' money. I started my career as a bankruptcy lawyer, so I've done a lot of these structurings and work out transactions. I understand how difficult they can be, but they are an important part of our skill set in mitigating against the downsides. So we think that having significant collateral package in our transactions for products that are essential to modern economies, that are needed for everyday life in highly liquid markets, allows us to get back our capital, protect the principal, and participate in the upside in case there is some.
Fine. So this is kind of like this is a niche within the credit world that you really need a specialist expertise and knowledge to play in. That's very tricky to do. You need to really understand the risk profile on the credit side, on the fraud side, and you can only do that if you have the right infrastructure in place, I guess.
That's right. It's really at the intersection of three things, right? Even though, the US, Canada, and Australia are very large commodity producers, most commodities are produced in the emerging markets.
Yeah.
So you have, number one, you have to have EM navigational skills.
Which we have because we're Gemcorp.
Because we're Gemcorp.
Yeah.
You have to have credit skills, and ultimately we are credit investors first and foremost. And you have to have the infrastructure that supports those navigational skills and credit analysis skills to come together. And we think that we are in a unique position to take advantage of this market and generate returns for investors. What's interesting for me is that with all this disruption is that you cannot onshore a copper mine. You cannot onshore a banana plantation.
Yeah.
They're subject to specific weather patterns. They're subject to specific topographies and geographies. So you have to operate in those markets. So if you're a lender to a toy factory in country X, that toy factory shuts down because they're moving it to country Y, you've just lost your entire collateral package.
Yeah.
We don't think that's possible for what we're doing. One, because this is global trade. It's continuous demand. You got 8 billion people increasingly using more electricity, increasingly eating more, increasingly drinking more coffee. Huge demand, consistent requirement for the products that we finance.
Yeah.
And these products are not easily movable.
Yeah.
On a going forward basis.
Yeah, and ChatGPT can't make you a copper mine either, right?
No, they cannot make you a copper. Yeah. They need a lot of copper to produce the answers, but they can't. They can't
onshore it.
Right.
Okay. One of the risks you didn't mention, and I was slightly surprised you didn't mention, was, and it's particularly topical now, of course, this kind of trade wars, tariffs. Our new favorite word. My sense would be that you're talking about global trade. This is going to be impacted by that, is it not? Help me understand why that's not one of the risks that you're worried about.
We actually, for better or for worse, we see a lot of opportunity in the trade disruption. Okay? So if I'm a commodity producer and I want to go into a country that's just put a bunch of tariffs on, my cost just increased. So I need more capital to enter that country. So I'm going to need significantly more capital to manage my supply chain on a going forward basis, right? My storage costs, the shipping costs have increased, so I need to store more of the product I need because I need to manage the frequency by which I ship my product. So I need more money to store the product. And so we think that that's increased demand for that. And in times of uncertainty, we can charge a higher risk premium on that return. The other thing we see is that if a market is now close to me as a commodity producer, because the tariff makes my coffee, for example, Vietnamese Robusta coffee, more expensive to enter into the United States, right? After a 46% tariff that's may go away was instituted against Vietnam, for example, right? The Vietnamese coffee producer cannot compete now with the Colombian and Brazilian coffee producer in the United States. Because they produce Robusta coffee that's bitter, so they can't compete on taste and they can't compete on price. So they need to find new markets for themselves, going into other parts of Asia, going into the Middle East, going into Africa or parts of Europe. And they need a global player with a global footprint that understands those markets, that can provide them with quick, flexible, and consistent capital to meet their needs and demands.
Okay. So that kind of flexibility in the duration of it really means that you have the ability to take advantage of it. And I suppose you're financing similar transactions, but with the same risk level and a higher yield because of this demand for capital, this sort of structural demand.
Yeah, ultimately it's driven by demand for capital and very little supply, right? If you look at in 2011, 2012, after 10 years where commodities did fantastically well, people were allocated to commodities in their portfolios 12%. Okay. Today, there was a Bloomberg article recently that showed that people have allocated portfolios generally have 1.5% allocation to commodities.
Okay.
It's an unloved, unwanted asset class, which means there is no capital to invest in this space. Yet the demand continues and is actually increasing. Because you need that capital to weatherproof farms, to manage new trade routes,
Yep.
to increase production of lithium and cobalt and copper. And so that mismatch is where why we like this commodity sector.
Yeah.
Because that's the inefficiency that we are trying to capitalize on for our investors. Because when you see a significant shortage of capital, meaning significant demand, we can structure transactions at the efficient frontier of risk-adjusted returns.
Yeah.
And we're typically the only term sheet in our transactions. We don't have competitions, global competitors.
Yeah.
And so we tend to basically can structure transactions from a pricing perspective and downside protection and covenants in ways that if somebody's competing with 5 other private credit fund or 5 other investors may not be able to.
Well, look, Ahmad, I think that's been an absolutely amazing introduction to the world of commodity credit. I think you've answered all of our questions that we set out to answer at the start in terms of what is it, how does it cross over with private credit, and the kind of outcomes it can offer investors, and much, much more. Thank you, Matt.
Thank you very much for having me. We think this is a fantastic asset class to be in, and we look forward to deploying more capital here.
So I will thank all of our listeners for joining us today. If you want to find out more, visit gemcorpcapital.com and get in touch with your regional sales representative.